This short presentation introduces the concept of liquidity risk management in banks, using components of the corresponding module found under Optimal MRM's e-learning service. Liquidity represents the availability of cash, or assets that may quickly be sold for cash, to pay for liabilities as they come due. The risk of failing to settle liabilities because of insufficient cash or liquid assets on hand can be narrowly defined as liquidity risk. In spite of having a well-capitalized balance sheet, a bank remains potentially exposed to liquidity risk. As such, a broader definition of liquidity risk includes a bank's inability to fund its balance sheet in a sustainable way. At a fundamental level, bank liquidity is a function of a bank's net cash flows. Cash flows are projected using models and assumptions that are imperfect. Realized cash flows may vary because of market or bank-specific changes. In spite of a bank's attempt to match asset and liability cash flows, uncertainties inevitably result in cash flow mismatches. In 2008, the Bank of International Settlements began to consider new requirements for liquidity in an effort to standardize the measurement and reporting of liquidity risk. This effort culminated in the development of the Liquidity Coverage Ratio, or LCR standard, and the Net Stable Funding Ratio, or NSFR standard. The Liquidity Coverage Ratio and Net Stable Funding Ratio metrics are broadly intended to represent market liquidity risk and funding liquidity risk, respectively. The Liquidity Coverage Ratio is calculated as a ratio of a bank's stock or pool of high-quality liquid assets and its total net cash outflows projected over a 30-day period of liquidity stress. The LCR standard requires banks to calculate their cash inflows and outflows over the next 30 days. Under the LCR standard, the aggregate amount of inflows that can offset outflows is capped at 75% of expected cash outflows. The HQLA pool is made up of unencumbered Level 1 assets, such as cash and government bonds, 85% of Level 2 assets, such as corporate bonds, and 50% of Level 2B, such as mortgage-backed securities and traded stocks. Cash outflow balances include retail deposits, wholesale deposits, secured funding, derivatives, and undrawn credit and liquidity facilities made available by the bank. The nature of the LCR construction is such that it is intuitively biased towards outflows as a function of a bank experiencing a rapid drawdown in customer deposits and to ensure it holds an amount of cash and liquid assets on hand, whereas the Liquidity Coverage Ratio measures short-term market liquidity risk. The Net Stable Funding Ratio measures medium-term funding liquidity risk. The Net Stable Funding Ratio is calculated as a ratio of a bank's available amount of stable funding and the amount of required stable funding over the next 12 months. Available stable funding includes regulatory capital and liabilities whose residual maturity is at least 1 year, 90 to 95% of retail and small business deposits, and 50% of wholesale deposits and commercial paper. Required stable funding includes loan assets, unencumbered Level 1 and Level 2 assets, and undrawn facilities. A bank's ability to operate and grow its balance sheet in a profitable way depends fundamentally on having enough market and funding liquidity. An excess amount of cash reduces exposure to liquidity risk, but also reduces bank performance. Holding fewer liquid assets can increase bank performance, but also increases its exposure to liquidity risk. Cash and liquid assets, such as government bonds and other traded assets, produce lower returns than less liquid or illiquid loan assets. The negative mismatch between assets and liabilities in the short end increases exposure to liquidity risk by requiring more frequent access to wholesale funding markets in order to roll maturing debt forward. This was a key driver during the 2008 financial crisis. Prior to this crisis, markets were buoyant and funding was readily available at low cost. As conditions reversed, liquidity became very expensive or evaporated altogether. A combination of excessive exposure to subprime mortgages, excessive balance sheet leverage, and over-reliance on short-term wholesale funding contributed to the bankruptcy of financial institutions such as Northern Rock Bank, Bear Stearns, Lehman Brothers, and Coventry Capital. These and other financial institutions relied less on deposits and disproportionately more on the issuance of asset-backed commercial paper and other securitization programs to maintain funding. This strategy proved to be unsustainable as credit conditions worsened and liquidity dried up. This was illustrated during the financial crisis by a substantial widening of spreads between LIBOR and OIS rates. The strategy of borrowing short-term and investing in high credit risk long-term carried a significant amount of liquidity risk, as illustrated by the liquidity coverage ratio and the net stable funding ratio. The associated liquidity position proved catastrophic as credit and liquidity conditions worsened during the financial crisis. Optimal MRM invites you to visit its store online to learn more about this and other available market risk e-learning modules.